Good morning, ladies and gentlemen, and welcome to the CQS Natural Resources Growth and Income PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. I would now like to hand you over to Chairman Christopher Casey. Good morning, sir.
Good morning. Thank you, Jake, and good morning to everybody. And thank you so much for joining us and listening to this webinar. What we've done is we've designed our slides to help explain the proposals that are being put forward by SABA and to reinforce our board's reasons for voting against those resolutions, which are to be proposed at the general meeting on the 4th of Feb. In a moment, I'll detail those reasons and the events up till now, and obviously at the end you're going to have a chance to ask some questions. But before that, I'd like to direct shareholders to our microsite via the link that's on your screen now, and you can see it in green on the first slide. It is cynprotectourinvestment.com. And if you go on that website, you can find out more information about the general meeting and indeed how to vote. If you have any doubt about any of this, please talk to your financial advisor. There will be a question and answer session at the end of the meeting, and you can still submit questions to today's speakers using the Investor Meet Company dashboard on your screen. We'll try to answer all questions in the allotted time, but we'll follow up any outstanding questions after the meeting. Should we have a slide there, Rob? Thank you. So the next slide in the deck is our disclaimer. You've got access to these slides afterwards, so if you want to read that disclaimer at your leisure, you certainly can. Okay, now on to recent events. As you'll be aware, on the 18th of December, the company received a requisition notice on behalf of the US hedge fund SABA Capital Management LP, requiring the company to convene a general meeting of shareholders. At the meeting to be held on the 4th of February, shareholders will consider resolutions to remove the current board of directors of the company and appoint Paul Kazarian of SABA and Mark Laughlin as new directors. It is our board's belief that SABA's proposals are without merit. They introduce new significant risks to your investment, and they're not in the interests of all shareholders. SABA's proposals will give them control to pursue their own stated agenda, including potentially to remove the investment manager, Manulife CQS, appoint themselves as manager, and change the remit of the portfolio, we believe for their own economic gain. SABA have put forward some misleading information on the performance of the company in their use of the benchmark analysis, using the MSCI World Energy Sector Index and ignoring the company's much more significant exposure to metals and mining. The company more appropriately uses the MSCI World Metals and Mining and MSCI World Energy indices and has outperformed both by approximately 35% and 39% in total net asset value return and 103 and 108% in share price total return, respectively, over 5 years. The performance of both indices is provided on the company's monthly fact sheet for comparative reference. We in the board, therefore, believe that Manulife, CQS, and the joint fund managers, who are widely recognised as being leading investors in their field, are the best team to continue the strong performance in natural resources sector that shareholders have chosen to invest in. SABA Capital have also failed to state how much cash they'll return to shareholders should they be successful in their proposals to replace your independent board with their appointees. SABA Capital are also expected to appoint themselves as investment manager to the trust, as set out in their statement to shareholders. The board of directors believe this will be for SABA's own economic gain and it introduces a significant risk to other shareholders. It's expected that SABA will change the company's investment policy from the strategy that shareholders have selected and invest their money in to an approach investing in other trusts for which no useful track record has been provided. Looking at the funds that SABA have taken control of in the US, they failed to narrow the discounts compared with those trusts' long-term averages. Were this to happen with your company, shareholders may become trapped at a long-term discount. Finally, SABA have proposed directors who we do not believe to be independent of SABA, with no experience in natural resources, and who, despite SABA's misleading claims, appear to have no experience in UK investment trusts. It is important to note the board has repeatedly attempted to engage with SABA to ascertain their aims, but they declined to provide their strategy, despite their misleading claims that they prefer private engagement with the boards of the trusts they invest in. In response to shareholder concerns, the board is currently reviewing all options that are available to us to preserve that value for shareholders, namely maintaining the current investment policy and management arrangements, introducing an increased dividend to be funded partly by capital growth, pursuing further discount management mechanisms, even providing a full cash exit at NAV for all shareholders. And if a suitable partner can be found to negotiate terms of a combination with another investment trust or open-ended investment company that would provide an ongoing investment opportunity with a natural resources and energy focus, together with the option of a full cash exit at NAV for all shareholders. In summary, your board is fully independent, has deep experience in investment trusts, natural resources, the UK investment management sector, finance and accounting, and as directors of quoted companies. Crucially, as it stands, your board is committed to creating and preserving value for all shareholders. If shareholders wish to protect their investment, I urge you to vote against the proposed resolutions at the general meeting on the 4th of February. I'll now hand over to Robert Crayford and Keith Watson, our joint fund managers, to detail the fund's current performance. Rob.
Great. Yeah, well, I mean, thank you for the intro. Yeah, so Keith and I are going to try and run through this pretty quickly because I appreciate, elephant in the room is obviously around the SABA activity, and we want to try and leave as much time for Q&A as possible. But we do want to spend some time and just kind of outline what we view as a very positive outlook through into 2025 and long beyond that, given the unique structure and formation of the fund. But just initially, so addressing the kind of performance question that has been raised by SABA and is their primary argument for their activity and their actions. They stated that the fund itself has underperformed its benchmark over the past 3 years. So as Chris mentioned there, the fund itself doesn't have an official benchmark. And that's because its prior benchmark, which was the EMIX mining index, was discontinued. And as a result, we provided the MSCI World Metals and Mining and MSCI World Energy as a reference on the fact sheet. As you can see here, so dark blue line is CQS Natural Resources share price, total return, and the green line is NAV. So as you can see, there's quite a material outperformance over the last 5 years, versus both those underlying indices. So firstly, the use of 3 years and the use of one of the indices that represents under 20% of the overall exposure of the fund isn't very representative. And this is the nature of the fund. It's historically been far more weighted towards metals and mining, and arguably would be the most reflective of the two, but we provide two as a better reference. One would think that if conducting extensive due diligence or by reading the fact sheet, that would be clearly evident to anyone having a clear look at that. So if you move on to the next slide, we kind of have a quick breakdown here for appreciating people may have different knowledges and different levels of knowledge and understanding around the fund. But we have the two pie charts at the top. So we break down the underlying commodities that we're exposed to via the miners, energy producers, or activity plays. On the right, we show our kind of geographic exposure, which clearly is heavily weighted towards sort of North America, Australia, and LATAM, and sort of high, not high risk jurisdictions per se, although we aren't against that with our African exposure, as there is an effective price versus risk for all of these exposures. So another thing to take away is geographically diverse, commodity diverse. We believe that reduces volatility through the cycle. But perhaps the most important chart on here is the bottom one, which shows the underlying exposure of the fund over the prior 5 years. The key thing to take away from that is the strategy of the fund is very much about an active and dynamic allocation. We view the value that we provide shareholders is for those that want exposure to the resources sector, but it remains volatile, uncertain, and has a lot of difficulties for the generalist investor. We provide our long-term expertise. I'm a geologist by education. I've been investing in resource stocks for 20 years. Keith, who just sat to my left, he's had 30 years investing in resources stocks. And there's a whole depth of experience, knowledge on management teams, knowledge on assets, and a deep understanding of the macroeconomics that drives that, with China, emerging markets, geopolitics, all key inputs into that. As you can see here, we break that down, and just to kind of talk through that lower chart, the dark sort of black line is the oil and gas exposure, which, as you can see, early in the 5-year period was a small weighting, materially increased it post-COVID as all those stocks sold off. That was materially supportive to alpha in the fund, and we have reduced that somewhat more recently. The biggest gain here in that kind of orangey gold, conveniently gold coloured segment, is the precious metal weighting, which we've materially increased over the last 12 to 18 months, and we'll touch through some of the aspects that we see as kind of key drivers there, and you can see that in that pie chart on the top left, is we have a large precious metal weighting. The key point to take from this is this active fund management, we believe, can provide strong returns through the cycle, protects against volatility, and makes the fund uniquely positioned versus other funds that are more specific sector exposed. And as a result, we think there's a very positive outlook coming into 2025, and we'll touch on that in a bit more detail around some of the key drivers we see in those underlying sectors. But another thing just to add on that is, another key differentiator is that zero exposure to iron ore. So precious metals, why are we so weighted towards precious metals? Well, we have a chart here showing the gold price itself in that kind of goldy yellow line blocked out below, and valuations of large cap, medium cap, small cap precious metal miners, which are now trading near all-time low price to NPV multiples. We have gold near all-time highs in dollar. If you look at that in other currencies outside of US dollar, particularly say Aussie dollar, which is a clear reference around producer currencies, it is more notably at all-time highs, and looks even stronger than that, given the relative strength of the US dollar versus other currencies globally. Valuations are depressed, gold at all-time highs. We're seeing record free cash flow generation for the sector. We believe coming into 2025, we're going to see further pickup in dividends being paid. We're going to see more buybacks, particularly given the love of North American investors for buybacks. And M&A activity is also likely to pick up, because we're seeing improving balance sheets from some of the larger producers who have underspent on exploration and are now looking to backfill and grow production against a strong cash generating underlying business. So on our name specifically, another reason we're very encouraged is we think the sector has kind of been overlooked, in part because post COVID rally in gold, we initially saw strong revenue increases for the producer sector overall, but then cost inflation fed through, and that ultimately squeezed margins back down. And we believe that's created a very negative sentiment for the overall sector. But what we're seeing now is quite a different dynamic, where we've had a material ramp up from around March last year in the gold price from around $2,000 to just short of $2,700 per ounce. But now we're seeing far easier cost pressures feeding through, with labour having been a major component, and that's now notably easing for those underlying producers, which mean that revenue increase is being captured in a much larger margin increase, which is feeding through to far better business outlook and cash generation for the underlying businesses. So gold itself, we could spend the whole hour talking about geopolitics in the current status, but I think what is clear to most people is that under Trump's next term, clearly volatility and geopolitics are going to be heightened. So as a minimum, we believe that's going to lead to continued strong, if not a pickup in central bank demand, as they look to diversify away from US treasuries and increase. And we're certainly seeing that through actions from the likes of China, who has returned back to adding back to their central bank reserves. And there's also an increasing question in a higher rate environment whether global debt levels are truly sustainable. And we're starting to see that question increasingly being asked. And as a minimum, we think that would lead to further allocation towards precious metals and its defensive properties going forward. So that's our reason for our large weighting towards precious metals. We also like oil and gas. It's a little bit more of a nuanced story, given that we aren't in a hugely tight market today, although that may be changing in the near term. But clearly longer term, what we are seeing is continued demand growth, primarily driven by emerging markets. Even with a slowing Chinese backdrop, we're going to see a pickup from India moving forward. But this isn't really reflected in kind of business plans from the larger majors, so the larger oil and gas producers, because they're being heavily constrained around ESG policy, dividends, buybacks, and capital return to shareholders. So we have a scenario where the kind of global messaging is that demand isn't growing, yet actually in reality it is, and this is clearly stated by this top chart, which is provided by the US Energy Agency, the EIA, and you'll see comparable information, or there's a slight discretion with the IEA. But yeah, so to that point, fossil fuels aren't dead. Valuations are very attractive. Many fund managers haven't been able to hold them because of ESG constraints, and we're seeing a real shifting message around that, where actually there's a shift back to focusing back on returns rather than direct ESG constraints. More recently, what we've seen is actually quite an encouraging backdrop where supply disruptions are certainly becoming more probable. And just in the last few days, we've seen heavy sanctions being applied by the US, following on from some sanctions by the EU on Russia's dark fleet. A lot of old crude shippers, or a lot of old crude ships that they bought post their invasion of Ukraine, which they've been able to use to circumvent around trade restrictions. What we've seen on Biden's exit is he's looking to sanction these, and that's going to most probably materially hamper Russian exports. And just as a reminder, Russia is now a larger producer than Saudi, which has a material knock-on to global balances and certainly creates uncertainty. Within that, we aren't just exposed to the oil and gas producers. We really like a lot of the activity plays to the big steel. So, some of the largest offshore oil and gas drillers, such as Transocean. We like crude shippers such as Frontline, which are going to see material benefits from any kind of sanctions here around shipping going forward. And I'll move on to the next slide, and I will pass over to Keith.
Thanks, Rob. Continuing on the energy theme, I'd say that we do look for broader investment themes and specifics beyond just the oil and gas and fossil fuel industry. And one of the key themes that we have been monitoring very closely over the last decade is the nuclear power market. And just to quickly explain the chart that you see here, the green line at the top represents the growth in demand for uranium, which is the raw fuel feedstock for nuclear power, on a low case demand growth outlook. The yellow below that represents the mine output of raw uranium feedstock. It struggled to close the gap to being a balanced market, and you can see that gap, even on the widening even on a low growth demand outlook, is widening quite considerably. We need several new, very large mines to come into production in a sensible time frame to address that. Coming back to the nuclear power market, I think one of the key factors that's driving the current renaissance is a result of its carbon-free baseload power generating ability. And the post-COVID global energy crisis really prompted a serious rethink of, I think, deliberately ignorant policy that just didn't like talking about this subject. And there has since COP27 been a sea change in both public and government opinion back in favour of this strategic sector. And let's not forget, it's responsible for, on average, 20% of the electricity generation in most Western markets. It is very strategic. The rethink is really now being reflected in very supportive policies that most governments around the world are enacting, as highlighted by the fairly ambitious target to triple generating capacity globally by 2050. I would reiterate that that's a target. There's no specific mandate to it, but I think it's a very important change in attitude towards this sector, given its core role in the energy mix. I think topically, one of the factors that's really highlighting the value of carbon-free baseload generating capacity is the more recent long-term power purchase agreements that big tech have been signing, which typically have been at twice the power costs that they could alternatively secure on just a different supply of grid, even renewables, variable renewables like wind and solar. So they recognize that having power available 24/7 every day of the week that's carbon free is a lot more valuable than might be considered by most people. And as I say, against that, we've got supply which is extremely limited and worsening, coupled to which, and further to Rob's point in terms of just the broader energy sector, it's also exposed to geopolitical risks. We've got Kazakhstan that controls more than OPEC in terms of its production of raw uranium at something like 40 to 45% of units produced from mines, and Russia, which commands a similar proportion of global enrichment capacity. And therefore the supply chain, which is exposed to these sort of political tensions, can really drive some price spikes from which the investments in the portfolio can benefit from very, very materially. Those companies that we invest in tend not to be hedged. I would say, and just to highlight Rob and my styles of investment, we don't go for the mainstream large liquid names. We don't think the structure of this fund is best suited for that. In the main, you could probably invest directly in those names more cheaply yourselves. We're looking to roll up our sleeves and look through, sift around the world for better opportunities, better valuations, and that give you full exposure to the upside, unlike, say, Cameco in this sector, which is sold forward 5 years and doesn't have much price participation at all to the commodity price. Another critical factor from this is often that people will look in and say, oh, but we've missed it. You must remember that the uranium as a proportion of the final cost of producing power is de minimis. It's the smallest of any of the baseload power fuels. Even at $100 a pound, which we have seen already this year, yes, we've backtracked, it's only something like 8% of the cost of producing electricity, which means it can move up and sustain that move very considerably for a long period of time. And that's what the companies in this sector really benefit and leverage off. And it's a cycle that's certainly not within any form of measurement of 3 years. We've seen a 10-year bear market, which has really limited the investment and that underinvestment is something which is coming home to roost now. There are very few projects ready to go off the rank, and the largest out there is a company called NextGen, which represents the largest position in the fund currently. That may change. We are dynamic, but at the moment we still feel that that project, which has the ability to be the largest producer of uranium globally, located in a tier 1 asset, established mining district in Canada with very capable management, is a very strategic asset in its own right. It may not remain under its own control because it is so strategic. But the fact is, demand is extremely well predicted, notwithstanding the support of more positive government policy. We've got huge growth continuing out of Asia. China will shortly rival the US in being the largest nuclear power market. It has really not slowed down in its rate of development of generating capacity because it recognizes the longer term benefits of having carbon-free baseload power. It is slowly, on a sensible time frame as it sees, trying to wean itself off things like coal, which are now looking to be effectively supplanted by the likes of uranium. Demand is very strong, and as I say, we're going to need multiple next gens in order to fill that supply gap that we're starting to see widen very considerably from the end of this decade. If I flip on, I won't labor that too much, but essentially, I would like to touch on a point that Rob raised earlier, which is industrial metals. Here we've titled it base metals, but we're probably at the lower end of our historic exposure. If we look back over that earlier page, back to 2015, for example, we would have had something very significant in copper. At the moment, though, one of the factors which is making us more cautious is essentially the Chinese property slowdown. And I think the important chart to really highlight on this page is that lower left one. And if I can just describe the background to it, the orange line represents property new starts by floor space in China. And we've tried to superpose that forwards to get the line of best fit on live completions. And that best fit line occurs if we move it forwards roughly 2.5 years. Now, the main point is that that orange line has dipped negative quite significantly. The last data that we have from this source was up to something like October, and it was down something like 20% year on year. If we were able to get an update of this, I think we'd be looking at down 30% now. Now, completions will follow that, but first of all, one of the primary industrial metals that goes into property development is iron ore. That goes in from the ground up, and unlike other sectors that Rob and I try and filter out, there's no shortage of iron ore really. The cartel that control that market, Rio, BHP and Vale, can produce at much lower prices, and they're not really showing any signs of curtailing production as it stands. There's no cost curve support, and if demand remains this weak, as we think most likely, given a realistic policy that trying to de-emphasize fixed asset investment in China, we think the iron ore market will struggle. For that reason, we have zero iron ore exposure. Though I would come back to the point I raised earlier, which is, in any event, it's controlled by large major miners such as Rio and BHP. You can own those more cheaply by yourself. And we accept that even in a bull market for iron ore, we would rather go for different companies to those. You can get the iron ore directly more cheaply yourselves and use us as a trust to search for better themes within that or alongside that. Moving on from that though, okay, we don't like iron ore, but completions are likely to follow the same trajectory as that chart in the lower left tries to indicate. And copper, a metal we do like to follow that electrification theme, is one that will still struggle despite our longer term like of it, because it goes into completion for wiring, air conditioning, white goods, and China, that represents something of the largest portion of China's own domestic use, notwithstanding the fact it's looking to export some of its semi-processed refined metal. ultimately, we just see better opportunity in the sectors that we've already discussed at the moment. The valuations of many of the large producers are already discounting probably a slightly too rosy an outlook, perhaps a spillover of a lot of commentary that this is the new oil. We are experienced in this, and I think that experience really just helps guide us in terms of the pace at which we think we'll wean ourselves off fossil fuels to try and be more realistic. We don't think, in summary, that pace of weaning off it, fossil fuels will be as quick as perhaps people hope, and the valuations are very, very attractive in that sense. But in copper, similarly, the pace at which it is rolled out on the electrification theme might similarly be slightly slower, and the valuations are trading at premiums to price to net asset value. That's a very different story to the earlier chart in goals. So for that reason, really, in summary, for the time being, we prefer exposure to other sectors at the expense of base metals and certainly ferrous metals like iron ore. I don't think I have too much to say on that, and I would probably hand back to our chairman, if you wouldn't mind, Chris, talking to a conclusion.
Thank you very much, Keith, and thank you, Rob, for taking us through the portfolio and some of the major themes that are ongoing. So to summarize what you've heard today, your board believes that the Sabra proposals are self-interested, without merit, and introduce significant risks to investors. Corporate democracy is at stake here. Sabra hold less than 30% of the voting, yet they're seeking to take control of the company and pursue their self-serving agenda. Sabra has only shared very scant details of their plans going forward. Despite repeated requests from us at the board, they've declined to engage and articulate their clear path, as they call it, until now. If they are successful in the current vote, we expect them to appoint themselves as manager, put in place a new investment strategy. There's therefore a real risk of shareholders becoming trapped in a trust that begins investing outside your chosen sector. Furthermore, as we've heard, Sabra have provided misleading information in their use of a flawed benchmark. Sabra have proposed new directors for the company, Paul Kazarian and Mark Laughlin, that we believe are not independent of Sabra and don't appear to have any experience in directing UK investment trusts, let alone natural resources trusts. The current managers, as they've just evidenced, are experts in natural resources and they're best placed to continue the strong performance in this natural resources trust. And that's evidenced by that performance since their appointment in October 2015. It's vital that shareholders vote at the general meeting on the 4th of February and vote against Sabra's resolutions for the reasons that we've detailed today. For more information on the proposals and how to vote, please do visit our website. I mentioned it at the beginning of the presentation, but you're going to hear it a lot, and it's CYN protectyourinvestment.com, or speak to your financial advisor. Thanks so much for your attention, and we'll now hand over for questions.
Perfect. Chris, Rob, Keith, if I may just jump back in there. And thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Guys, we have received a number of questions that were both pre-submitted ahead of today's event, as well as those that have come in throughout your presentation this morning as well. So perhaps if we dive straight into it, the first question that we've got here reads as follows. What happens if I don't vote at all?
Okay, so if you don't vote at all, what will happen is that Sabra's 29% holding, minority holding, will cause them to win the resolutions. The next thing happens is that your current board will be replaced by Paul Kazarian and Mark Laughlin, who, as I've said earlier, have got no experience of directing investment trusts, and we don't think they're independent of Sabra. Now, it's not clear what they will do once they're appointed. But they've certainly said in documentation that we've seen that one of the options they're looking at is investing in changing the investment objective and investing in investment trusts at a discount. So this introduces a new investment objective for your investment with all the attendant risks that come with that.
Thanks, Chris. The next question that we have asks, what experience does Saba have of managing an investment trust like the company?
None. Short answer. I mean, we've just heard from Rob and Keith, and you can tell from their presentations, these guys are real experts in their field. They've got some very specialist knowledge and long experience in the sector. And we do not believe that Saba have that sort of resource available. Furthermore, the directors don't have any apparent experience of being directors of UK investment trusts. So you know, I think the short answer is none.
And I'd like to add a point there in
Please,
that
Rob.
not only
Keith.
would we question their use of an energy benchmark, which is not factually correct, as the DD would have pointed out, as Rob said, but to also single out a 3-year period, as we've tried to illustrate, is really not something that is really ideal for the sort of cycles that we're trying to invest in. You know, take the nuclear cycle, for example. We started seeding investments into NextGen in 2015-16 at something like 50 cents. It's now $10. And, you know, it's still got a very favorable outlook in terms of its strategic worth from here. We invested in slightly quicker cycle things like lithium. We bought a company called Sigma, one of the lowest cost producers, back in 16, 17, probably similar time actually. And it did nothing for a couple of years, and then it went to $50 from about $1. And you know, those are the type of investments that we are looking for ultimately. Clearly, they're the best ones that we would point to. But I think the crucial fact is that you need to take a pragmatic stance on a period of time, and to just choose on one probably worst period of time against a not really relevant benchmark and effectively exploit a voting mechanism which strands retail investors who in the main hold their shares on nominee accounts, I think just highlights the fact that there is a flaw there. And I can't reiterate enough how much I hope people will actually engage now in that voting process. Follow the instructions on the microsite, protectyourinvestment.com, and really vote, because the turnouts on historic AGM meetings, I think, well, they won't be enough. You know, if we get another 10%, well, 30% or nearly 30% will steamroller us. And so, you know, please highlight that and vote.
Thank you both. The next question asks, what expenses would the Saba vehicle charge compared to the current fees?
Well, we don't know because they've not made that clear, and which is outrageous because they are suggesting they're going to change the manager, change the investment mandate, but they haven't said how much they're going to charge, how much shareholders, how much in the way of cost shareholders are going to have to bear of their charges to make this change. So I said earlier they provided scant details. I mean, there's no details at all on their charges. It's absolutely outrageous. I mean, all I can tell you is that where they've done similar things in the US, their charges are higher than the charges that actually all of the 7 investment trusts affected by this are typically charging. So, you know, I don't know, but it's likely to be more.
Thanks, Chris.
Yeah,
sorry.
I mean, I just add to that as well. I mean, they talk about a management fee, as we've seen with their US trusts, which you know is sort of comparable. I think the thing to look at is the total expense ratio, where I think one of their trusts was over 6%. So there's direct fee, but the expense ratio of running those, you know, certainly with one of the examples, is clearly notably higher.
Perfect, thank you. SABA have stated that they will offer Herald a full cash exit at 99% of NAV after 1 year. Have they made a similar statement with CQS at all?
No, they haven't. All they've said is that they'll offer substantial liquidity near NAV. Again, one could look to the US as a guide, and in the US they've offered, I think, between 30 and 45% in situations like this. But obviously we can't make any comment on what their proposals are with another investment trust. We can only speculate why they appear to have changed their position on this. But I think it's extremely unlikely that they will. Extremely unlikely that they'll offer us a 99% cash exit. If they were to do that with all the investment trusts, they won't end up with a vehicle in the UK, and it's pretty clear that's what they want.
Thanks, Chris. The next question asks, are the boards of the other 6 trusts aligned with your position?
Yes, they are. All other 6 are producing very strong defence positions in relation to this. I think everybody feels the same. They feel that this is a ploy to get control of a series of investment trusts in the UK on the back of a minority shareholding, which, as I said earlier, is outrageous.
Thank you. Just turning to the next question, can you speculate on SABA's endgame?
I don't know it, but I suppose I can speculate. I mean, what's interesting here is that we had a continuation vote at our recent AGM, and they chose not to vote in that at that AGM. So they could have caused the company to liquidate by voting against continuation. But they chose not to. And I said earlier, it would appear they want a vehicle in the UK, and that's my basis for saying that. They had the opportunity to put us into liquidation, to cause us to have to return money to shareholders, which we would have done, obviously, at pretty close to NAV. But they didn't exercise that right. So we can only assume that what they really want is they want the vehicle to pursue their own self-interested ploys, their own self-interested objectives.
Yeah, I mean, if I can add to that, I mean, I think, if we look to what actions are rather than what they're saying, I think the point is exactly right. If it's about closing the discount, they could have voted against continuation. So the actions would suggest it's around acquiring assets at a discounted, acquiring AUM at a discounted level and taking control. And within that, I think they've clearly taken a view around sort of retail shareholders, and maybe that they won't vote, or they won't realise, or they won't offer to tender, and as a result, they could change their mandate, take control, change the fees freely, and a number of shareholders might not exit or would stay there. And I think that's the thing that sort of deeply worries. It certainly worries me personally, is that kind of minority shareholder that isn't necessarily on the ball, isn't seeing kind of votes, isn't even able to tender into even if it's a partial tender. And I'm kind of deeply concerned that those are the ones that could be taken advantage of.
Thank you both. Why are SABA holding a portion of their shares in swaps?
I don't think we can really comment on that. I mean, it's obviously that's SABA's choice. We've got no insight into why they've chosen to do that. Seems a bit strange, but that's it's for them to answer that question, I think.
Perfect, thank you. And why has SABA targeted this trust?
Well, again, we can speculate. I mean, we don't know. They haven't said why they've come to our door. The speculation, I guess, is that we have had historically very low turnouts at our AGMs. Keith was mentioning this earlier. I think it was 10.2 at the AGM in December. So that gives them a very strong opportunity to take control with their 29%. So my perhaps suspicious mind suggests that they've seen that we are in a position of weakness with a very large retail investor base on our register, which we're very proud of actually. But those retail investors tend not to vote. And so we're encouraging everybody. That's part of what today's all about, encouraging those retail investors to understand what SABR's proposals are, to think about them and to vote against those proposals.
I think that's right. I think the timing, the lack of engagement prior to the AGM at which they didn't participate, the continuation vote in which they didn't participate, I think really just highlights that they're exploiting that.
Thank you. Assuming that SABR proposals are defeated, will there be any change to how the portfolio is managed?
Yeah, that's a good question. We always look at options as to how the portfolio is managed, and obviously we discuss those with investment managers. We have a strategy review annually to consider what options are at the board's disposal, and we've accelerated that in view of this interest by SABR. So in that strategy review, we'll look at all options. One of the options would be to continue the fund exactly as it is. There are other options. We could try and increase the dividend. To do that, we'd need to use some capital reserves. We could consider returning money to shareholders. We could liquidate the fund if we thought that was in the shareholders' best interest. It's definitely one of the options that's on the table. We could consider a combination with another investment trust or an open-ended vehicle investing in the space. So look, we're looking at all those things. I think we're extremely happy with the team that we've got at CQS, and I think they've just demonstrated their extensive knowledge. But you know, rest assured, we don't leave any stone unturned in considering all the options on an ongoing basis. So yeah, we'll be looking at the options available in the coming months.
Thanks, Chris. Just turning to the next question, which asks, do you think SABR will sell their stake if the vote goes against them?
Yeah, who knows? I don't. I mean, I really don't know the answer to that. And again, it's really one for SABR. We can only speculate, but I think they put a lot of effort into getting this position and getting these positions in the other 7 trusts. And by the way, there's about another 20 or so trusts outside the 7 where they've also got positions. So I think it's a little unlikely that they're just going to put the shares back on the market and walk away. But we don't know. We'll have to cross that bridge when we come to it.
But first things first, what we actually need to see is the voting now. I think if we can get that, it's probably a fair reflection that people have taken umbrage quite indignantly, thankfully, at this approach, which feels like an exploitation of a voting right that retail shareholder bases has and needs to take. If they can do it this occasion, I would like to think they could do it at subsequent occasions.
Perfect. Thank you both. What happens where a holding is in a nominee account and the broker does not vote on the holder's behalf?
You'll need to call them.
Yeah.
You'll need to call them and talk them through and get them to guide you through the way in which you need to lodge your proxy vote. And just be aware that whilst the date of lodgement shown on this slide here says 31st of January, your individual nominee account may require you to lodge it before that. So time is of the essence.
Thank you. Just turning to the next question, are you buying actual gold or ETFs or miners?
I can take that. Yeah, so it's the miners, and it's the miners where we kind of see the most attractive opportunity. We can own the physical via ETF should we think that's a preferred exposure, but actually we're seeing the best opportunity, or we believe we see the best opportunity in the miners themselves, given the sort of hugely discounted valuations versus historic norms, record free cash flow, strong internal catalysts as well, given that kind of segment of the market where we focus, around that sort of $500 million to 3 billion type market cap, which is kind of where we kind of see the best opportunity, as it falls below some of the most liquid names, which we think structurally are ultimately slightly flawed, with the largest of the precious metal miners almost being too large for the underlying sector and the way geological ore bodies are formed. So they're having to chase ore bodies that aren't necessarily as economic as ore bodies that suit those kind of more sort of mid cap type corporates.
Thanks, Rob. Um, can you affirm what the voting percentage must be to block the SABA proposals? And if it is blocked, how the board would then engage with SABA to address their potentially continuing antagonistic position?
Well, it appears that SAB has got 29%. So it looks like we need to get more than 29% to block their position. That's the baseline. And then, of course, we'll absolutely engage with them to try and understand what their next steps are. And, they are a shareholder. We have a duty to them, as to all shareholders, to try and understand their objectives and help them to achieve those objectives, subject to the fact that the consideration that our action should be in the interest of all shareholders, not just not just Saba. I should say that we've tried to engage hitherto without any success, to be completely honest. So we will absolutely reach out to them and see where that goes. But just right now, we need to just get it across the line.
Thanks, Chris. The next question is from a long-term holder who says they fully support your opposition to the SABA proposal. And then there's two
Good.
questions here. The first one is that TR1 show that SABA have an 8.7% holding rather than the 30-ish percent mentioned in your slide. I can't see from your website the names of the other major shareholders. Are there any withholding similar / greater than SABA, and have they made their position public? And the second question asks, I've noted comments that your management charges are too high, 2.5% on AJ Bell. Can you please comment?
Okay. So the first question is relating to an apparent 8.7 holding rather than 30%. So what Saba is doing is they're using nominees. So it has been quite difficult actually to track their actual position. We've obviously been tracking it for a little while, but they're using nominees and they're using total return swaps. So their position is a bit opaque, but we believe they either have or can have up to 29% voting rights at the general meeting. So do you want to comment on that, Rob?
Yeah, I mean, I can add to that. Yeah, so they hold it through a number of nominees, and it shows up. We see that through Barclays, through Goldman, and then there's some Saba Direct. The stuff that you see for Saba Direct is where they've actually converted the swaps into shares. Thus, it shows as Saba. But we know they have these holdings when you include those different nominees, and they actually publicly state that themselves in their documents around this. They state their ownership in the seven trusts.
And they will be dematerializing those swaps and total return contracts in order to cast their votes. So I guess there are a couple of benefits of holding them in nominee accounts. One, you don't see a more stealthy route to gaining ownership. You've suddenly got to be informed, which probably occurs on an official rise in shareholding towards the end of that capture of shares. And the second benefit might be that if you're uninformed as to their nominee holdings, you think, oh, well, they've only got less than 9% without any effort. There was a 10% vote, typically, so I don't need to vote. And that is a misconception.
Maybe on the second question, there was a comment there around management charges. So the fee is 1.2%. I think that 2.5 is perhaps referencing to the total expense ratio, which is one of the cons of investment trusts and their structure. The pros are obviously it being closed-ended, is that it kind of gives a bit more flexibility about the investment style rather than just chasing liquidity like you get with ETFs. But with that, and that general oversight from kind of board costs, general management costs, etc., over and above. So I think that's the difference between those numbers, and it's certainly comparable to other trusts.
And in fact, the proposed SABA management fee structure is not that dissimilar, but their expense ratio is twice that plus on the funds that we can see.
Yeah, thanks both. I mean, I would say that we have a process on the board for reviewing the commercial arrangements with our investment manager annually. And part of that process involves challenging them, obviously, and benchmarking the fee that we pay against similar trusts. And we're happy that that fee is at the market. Of course, the percentage is driven by two numbers, and one is to do with the size of the investment trust. And of course, that's one of our problems. We are quite small, and were we to be double the size, obviously the expense ratio would come down. This is one of the tricky things about share buybacks, that we all want the company to be bigger for multiple reasons, better liquidity, but also a better expense ratio. Buying back kind of moves against that. So I think the 2.5 is well, like I say, is a function of size as well as absolute amount.
Thank you all. Assume SABA's proposal is voted down. There will be a dominant, likely hostile shareholder. This may be destabilizing for the management and governance of the trust. Alternatively, their shareholding will be a considerable stock overhang. Both provide considerable risks for shareholders. What actions could the company take in such an outcome?
Yeah, it's a good question. It is, some might say, a $64,000 question. I would plan to engage, and as what we were saying earlier, and really hope that we could make some progress. I think the likelihood of SABA just dumping their stock on the market is a bit it's a bit unlikely, that tactic, because that's going to damage the price they're going to get for it if they try and unwind the whole position immediately. So my thought is, if they did want to exit, they would exit over time. And of course, we would look at all ways in which we could help them get off the register without causing any damage to the company.
If I can add a point to that, I mean, one of the differences and unique things with this, well, not entirely unique, but it has some of the best corporate governance in that it has an annual continuation vote. So, as a minimum, they could wait for the next December AGM and look to vote on a continuation, around continuation again, which would present another issue. I think more likely they could potentially look around in discussion with the board, and this isn't a role for me, but there could be a sort of tender situation option possibly, which could be discussed with, which obviously would be open to all shareholders, and that was exactly in that point made earlier around the board review and options they're discussing. So not my side of the fence, but I thought I'd just add that in so that was clear.
Thanks, Rob. That's helpful.
Thanks, Rob. Thanks, Chris. Isn't there a question of overboarding for SABA too? Is the next question.
Yes, there certainly is. I mean, I think the proposal that we've got from SABA of Mark Laughlin and Paul Kazarian, together with the other proposals for the other investment trusts, would put them in a position of being overboarded. And of course, that doesn't take into account any of their other responsibilities in the US. So yes, they'll absolutely be overboarded. To be honest with you, I think the bigger question is their independence. I can assure you that we take our responsibilities incredibly seriously on this board, and being independent of the manager is a critical feature of investment trusts. And of course, if they appoint Saba as the investment manager, then they won't be independent. So they will be overboarded and they won't be independent, which is, frankly, two red lines, governance red lines that have been crossed.
Perfect. Thanks, Chris. The next question asks, so will they, Saba, be able to commit their time to the fund?
Well, that's a good question. Again, we don't know, so we don't have any. We don't have really any insight into their capabilities, but it seems extremely unlikely that they're an organization that could take over 7 investment trusts in a variety of different sectors. Some complicated to liquidate if that's their intention. And it's really hard to understand how they would achieve that. So I think yeah, it's a good question. We can only speculate, but it's really difficult to see how they have got adequate resources to manage the investment trust they're looking to take over.
Thanks, Chris. And the final question that we've got here is, when is your next annual continuation vote?
Well, Rob has referred to that. We actually have an annual continuation vote, which I think is the best sort of governance that really any investment trust can have. I mean, most investment trusts now have a 3, sometimes 5-year continuation vote, but we actually have one annually. So the shareholders get a chance to vote on whether this trust should continue every single year. I think we're proud of the fact that we get that annual support from all our shareholders. We're delighted with it, but we also think it's ranks very high in the governance with which we organise the company's affairs.
Thanks, Chris, and thanks, Rob and Keith, as well. That actually concludes the questions that we've had today. So thank you very much for being so generous of your time there and addressing all of those questions that came in. But Chris, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Yeah, thank you so much. Look, I think you've heard a lot from us today. You've heard quite a bit from me about the Saba proposals, and you've also got a sense of the expertise we've got in Rob and Keith. I do think that this investment trust does something completely unique. It is allowing exposure to for a number of investors, a number of retail investors, to stocks or to the sector and stocks within the sector, which frankly would simply not be available to them if it wasn't for this investment trust. So to me, it's something that is extremely valuable in the market. And I would really urge you to look at the Saba proposals and think about them. Please read our circular and come to your own conclusions. But I think you'll see that we've argued very persuasively that what you should do is vote against. I emphasize vote against the resolutions that are being put forward at this general meeting. And if you're in any doubt how to do that, then please visit our website, CYN protectyourinvestment.com, and that should help you. Thank you very much.
Perfect. That's
Thank you.
great. Chris, Rob, Keith, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CQS Natural Resources Growth and Income PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.